A fundamental shift is underway in global reserve management as emerging market central banks increasingly diversify away from dollar-denominated assets toward physical gold holdings. This structural change, driven by monetary policy uncertainty and geopolitical risk assessment, may create persistent upward pressure on gold prices while potentially destabilizing traditional precious metals market dynamics. Central bank gold purchases reached 1,136 tons in 2022, the highest annual total since 1967, according to the World Gold Council. More significantly, this buying has become structurally persistent rather than cyclical. Emerging market central banks, led by institutions in China, India, Turkey, and several BRICS nations, have sustained elevated purchase volumes through 2023 and into 2024, suggesting a strategic rather than tactical reallocation. The traditional 60-40 dollar-euro reserve split that dominated emerging market central bank portfolios for decades is giving way to a more diversified approach. Gold now represents approximately 15-20% of total reserves for several major emerging economies, compared to historical averages of 5-10%. This shift reflects growing concern about the weaponization of dollar reserves, as demonstrated by sanctions against Russia's foreign exchange holdings. While Western media often frames BRICS gold buying as coordinated market manipulation, the reality appears more nuanced. These central banks are responding to similar structural pressures. Domestic political pressure to reduce dollar dependence, concern over Federal Reserve monetary policy volatility, and the need for sanctions-resistant reserve assets. The Shanghai Cooperation Organization and BRICS forums have provided platforms for central bankers to share best practices in reserve diversification, but evidence suggests independent decision-making rather than explicit coordination. Each institution faces unique domestic constraints, from China's gradual capital account liberalization to India's import financing needs. However, the aggregate effect creates quasi-coordination. When multiple large buyers enter the market with similar timeframes and objectives, price impact becomes amplified even without explicit cooperation. This phenomenon resembles the unintentional coordination seen during the 1970s petrodollar recycling, where individual rational decisions created systemic effects. The shift toward physical gold holdings creates potential stress points in the global bullion market infrastructure. Traditional paper gold markets in London and New York rely on fractional reserve principles, where physical backing represents only a small percentage of outstanding paper claims. Emerging market central banks increasingly demand physical delivery and domestic storage, diverging from the traditional practice of holding gold in Bank of England or Federal Reserve vaults. This preference for repatriation creates logistical challenges and may strain the physical delivery mechanisms that underpin paper gold pricing. The London Bullion Market Association's clearing system, which handles approximately 70% of global gold trading volume, operates on the assumption that most participants will settle financially rather than demand physical delivery. If delivery requests from central banks continue rising, the system may face liquidity constraints during periods of market stress. This structural demand shift is creating observable changes in gold market behavior. The traditional inverse correlation between real interest rates and gold prices has become less reliable, as strategic buying from central banks provides a price floor that persists even during periods of rising real rates. Futures market positioning data reveals growing backwardation in longer-dated contracts, suggesting physical scarcity concerns. The spread between London spot gold and COMEX futures has widened periodically, indicating stress between paper and physical markets. Exchange-traded fund flows have become less predictive of gold price movements, as institutional demand from central banks operates independently of retail investor sentiment. This decoupling may reduce the effectiveness of traditional gold trading strategies based on ETF positioning. Central bank gold buying reflects a broader reassessment of geopolitical risk in an increasingly multipolar world. The freezing of Russian central bank assets demonstrated that even reserve currencies carry political risk when held in jurisdictions that may impose sanctions. This realization has prompted not only adversarial nations, but also neutral countries to reconsider reserve composition. Swiss National Bank discussions about gold repatriation, historically unthinkable, illustrate how broadly this reassessment extends. The insurance value of gold becomes more apparent as traditional diplomatic conflict resolution mechanisms weaken. Central banks view gold holdings as protection against both financial sanctions and currency manipulation, creating a new category of strategic demand that transcends traditional economic fundamentals. Mining production growth has failed to keep pace with central bank demand growth. Global mine production increased only 1.7% annually over the past decade, while central bank purchases have accelerated. This supply-demand imbalance may intensify as existing mines mature and new discoveries become scarcer and more expensive to develop. Recycled gold supplies remain price sensitive but cannot fully offset the supply gap during sustained price increases. Central banks, unlike private investors, demonstrate limited price sensitivity in their purchase decisions, prioritizing strategic objectives over cost optimization. The structural nature of this demand shift suggests persistent upward pressure on gold prices, independent of traditional monetary policy cycles. However, several risks could disrupt this trend. A resolution of major geopolitical tensions could reduce the strategic premium embedded in current gold prices. Technological innovations in digital central bank currencies might eventually provide alternative reserve assets that offer some of gold's sovereignty benefits with greater liquidity. More immediately, a severe global recession could force emerging market central banks to liquidate gold reserves to support domestic currencies, as occurred during the 1997 Asian financial crisis. However, current emerging market foreign exchange reserve levels appear more robust than during previous crisis periods. Central bank gold diversification represents a structural shift in global reserve management, driven by geopolitical risk assessment rather than traditional monetary considerations. This change creates new dynamics in precious metals markets that may persist regardless of Federal Reserve policy cycles or inflation expectations. The implications extend beyond gold pricing to encompass questions about dollar hegemony, financial system stability, and the evolution of international monetary arrangements. As this trend continues, market participants will need to adapt their analytical frameworks to account for strategic demand that operates independently of traditional economic fundamentals. Regional banking institutions are amplifying this trend through multilateral cooperation mechanisms. The Asian Infrastructure Investment Bank and the New Development Bank have begun accepting gold-backed securities as collateral for infrastructure projects, creating additional institutional demand channels. These regional financial institutions provide emerging market central banks with alternatives to traditional Western-dominated financial infrastructure, reducing reliance on dollar-based settlement systems. The establishment of bilateral currency swap agreements between BRICS nations has facilitated direct trade settlement outside the dollar system, reducing the need for large dollar reserves while simultaneously increasing gold's appeal as a neutral settlement asset. China's renminbi clearing banks and major financial centers now offer gold-backed trade financing facilities, providing commercial banks with alternatives to traditional letters of credit. Historical precedents suggest this diversification trend may accelerate during periods of financial stress. During the 2008 financial crisis, central banks initially sold gold to maintain liquidity, but quickly reversed course as confidence in paper assets eroded. The current diversification occurs during relatively stable conditions, suggesting stronger commitment levels that may prove more resilient during future crises. The mining industry has begun responding to this structural demand shift by prioritizing long-term supply contracts with central banks over spot market sales. Major producers, including Barrick Gold and Newmont, have established direct relationships with emerging market monetary authorities, bypassing traditional bullion banks. This disintermediation could reduce the pricing influence of paper markets while creating more predictable revenue streams for mining companies. Exchange-traded product providers face mounting pressure from this trend, as institutional investors question the sustainability of their business models. Physical ETFs must compete for limited available gold inventory with central banks that offer premium prices for guaranteed delivery. Several major ETF providers have quietly increased their physical backing ratios to maintain credibility, effectively tightening physical supply further. Digital central bank currencies represent a potential long-term challenge to gold's reserve status, offering some sovereignty benefits with greater transaction efficiency. However, current CBDC implementations remain experimental and face significant technological and political obstacles. The Bank for International Settlements estimates widespread CBDC adoption remains at least a decade away, providing gold with an extended window of strategic relevance. The timing of this reserve diversification coincides with broader shifts in global economic power. The International Monetary Fund projects that emerging market economies will account for 60% of global GDP growth over the next decade, up from 40% historically. This economic rebalancing provides these nations with greater financial resources to implement strategic asset allocation decisions independent of Western financial market preferences. Interest rate differentials between developed and emerging markets are narrowing, reducing the opportunity cost of holding non-yielding assets like gold. As emerging market central banks achieve greater monetary policy credibility, their domestic bond markets become viable alternatives to developed market securities for international reserves. This creates fiscal space for gold accumulation without sacrificing yield entirely. Commodity exporting nations face unique considerations in their reserve management strategies. Countries with significant mineral exports, including gold producers like Russia and South Africa, view gold holdings as natural hedges against commodity price volatility. This creates structural demand from nations seeking to balance export revenue fluctuations through strategic reserves. For precious metals markets, The quiet revolution in central bank reserve management may prove more consequential than headline-grabbing monetary policy announcements or inflation data releases. The structural nature of this shift suggests it represents a permanent change in market dynamics rather than a cyclical phenomenon.